Welcome to this episode. Today we're discussing a high-stakes topic, the elephant in the room for the US and even the global economy. How will the US resolve its $37 trillion national debt? $37 trillion. What does that even mean? It's equivalent to 126.8% of US GDP. If we think of the US as a household, not only does it spend its entire annual income, but it also takes on a massive debt burden that's even heavier than its annual income. And this figure is growing by billions every day. For years, from Wall Street legend Ray Dalio to former Treasury Secretary Larry Summers, countless leading economists and media outlets have been warning of an impending debt crisis. Strangely, this crisis seems to be perpetually lingering on the horizon. The U.S. economy continues to thrive, and the U.S. dollar remains the preferred currency for global capital. What's the secret behind this? Does the U.S. truly intend to repay this astronomical debt in full? The answer may be more complex and even more brutal than we imagine. Today, we'll attempt to unravel this mystery and predict the most likely strategy the United States will adopt to resolve its debt problem. To understand the U.S. debt dilemma, we must first understand the underlying logic that has driven global economic growth for decades, and why this logic is irreversibly collapsing. At the heart of this logic lies the natural privilege that the U.S., as the world's leading superpower, confers upon the U.S. dollar its status as the world's reserve currency. Simply put, the world needs the dollar for trade settlements and foreign exchange reserves. To meet this enormous demand, the U.S. must continuously supply the world with dollars. How does it do this? The most direct way is through a massive trade deficit, buying large quantities of goods from other countries and paying for them with its own printed dollars. For decades, this model seemed to be a good deal for all parties involved. The U.S. received cheap goods from around the world and enjoyed a life of low inflation, while major exporting countries like China, Japan, and Germany earned vast sums of dollars and accumulated wealth. These countries then reinvested these hard-earned dollars back into the U.S. by purchasing U.S. Treasury bonds, effectively lending the money back to the American people. This was a seemingly perfect global economic cycle. Wealth doesn't emerge or disappear. It only shifts. However, this cycle, like the two sides of a coin, brings benefits while also harboring two fatal risks. The first is the hollowing out of American manufacturing. When complacent U.S. policies deliberately maintain the dollar's strength, American-produced goods lose their price advantage in the international market. In pursuit of lower costs and higher profits, companies relocate their factories to Asian countries, where labor is cheaper. This directly led to the creation of America's much-vaunted Rust Belt, the loss of numerous manufacturing jobs, and a sharp widening of the wealth gap. The dollar's natural privilege has gradually become a burden that crushes American workers. The second is the complete collapse of the U.S. government's fiscal discipline. With a constant influx of overseas funds to finance its deficits, Washington politicians seem to have a credit card with unlimited overdrafts. No longer needing to live within their means, they are accustomed to issuing new debt to cover old debts and ever-increasing government spending, whether it's social welfare, defense budgets, or interest on the national debt. We know this is unsustainable. It will inevitably come to an end. Now, this model, which has operated for decades, has finally reached a critical point. On the one hand, the political climate in the United States has undergone a fundamental shift, with calls for the reshoring of manufacturing and a change in the unfair trade structure growing louder. This has led to tariff wars and the introduction of various industrial reshoring policies. This, in essence, is the beginning of a process of deglobalization. On the other hand, years of excessive money supply, especially after the unprecedented rounds of fiscal stimulus during the pandemic, have finally ignited the ferocious tiger of inflation. According to the latest data, even after the Federal Reserve's most aggressive interest rate hikes in 4 decades, the core inflation rate by mid-2025 will remain stubbornly around 2.9%, consistently above the Fed's 2% target. The purchasing power of the dollar is being relentlessly diluted before our very eyes. Thus, American policymakers face a nearly unsolvable policy equation. On the one hand, the nation's sky-high debt requires low interest rates to maintain. Otherwise, the ever-increasing interest payments alone would be enough to overwhelm the federal government. Furthermore, A weakening economy also requires low interest rates to stimulate growth. The latest employment report shows that new jobs were far below expectations, and the data for the previous 2 months were significantly revised downward. A clear sign that the economy is losing momentum. Furthermore, geopolitical considerations and national strategies for industrial reshoring require a relatively weak dollar to enhance the international competitiveness of domestic manufacturing. On the other hand, stubborn inflation demands that the Federal Reserve maintain high interest rates to safeguard its credibility in controlling prices. Furthermore, as the world's dominant power, the United States must maintain dollar hegemony. This natural selection process among global players in turn supports its dominance. Therefore, U.S. debt cannot become a completely useless IOU for debtors, otherwise chaos will ensue. These two realities are fraught with sharp and nearly irreconcilable contradictions. Traditional solutions, such as fiscal austerity like in Greece or drastic tax increases like in post-war Europe, are completely unfeasible in the current U.S. political climate. Any politician attempting to cut social welfare benefits or significantly increase taxes is committing political suicide. Governments that impose hardship on their citizens simply cannot succeed, as history clearly demonstrates. So, when all conventional remedies have failed, what is the solution? To solve major problems, one must be ruthless. When all traditional avenues are blocked, the only remaining option is a gamble of trading time for space. This is the core logic of current U.S. economic policy and the key to predicting the direction of global asset prices over the next decade. The first step in this strategy is a seemingly reasonable and hopeful open plan. Its core idea is to stop obsessing over the total amount of debt and instead focus on reducing the debt-to-GDP ratio, as U.S. Treasury Secretary Benson put it. We can understand this with an analogy. If you owe $1 million in debt but only earn $100,000 a year, your debt-to-income ratio is 10 to 1, and your financial situation is extremely precarious. However, if, through hard work and investment, you increase your annual income to $500,000, then while you still owe $1 million, your debt-to-income ratio has dropped to 2 to 1, making the debt look less formidable. What the United States needs to do now is to do everything possible to increase GDP, the denominator representing the total economic output, so as to make the debt-to-income ratio of 126.8% look less daunting. How can the GDP pie be expanded? The answer is to change the nature of the new debt, shifting it from unproductive debt to productive debt. This is a crucial distinction and key to understanding the logic behind policies like the big bill. What is unproductive debt? It's like using a credit card to travel or spend money. It can bring temporary economic growth, but it doesn't itself create future income. The pie doesn't get bigger. It just takes a few bites early. Over the past few decades, the majority of the U.S. debt has been used to pay for social welfare, defense spending, and the ever-growing interest on the national debt. Data shows that currently, approximately 73% of every dollar spent by the U.S. federal government is mandatory for social welfare and interest payments. These are all unproductive debts that only contribute to the growing debt pile. Productive debt, on the other hand, is like taking out a loan to build a profitable factory or investing in education that will enhance your future job skills. While these investments are also debt in the short term, they generate future cash flow and economic growth, and hopefully will eventually pay themselves back. We've seen that the core purpose of a series of recent policies is to attempt to direct increased government spending toward areas that can boost long-term productivity. The so-called Big, Beautiful Bill is a general term, but the policy direction it represents is clear. Through large-scale tax cuts, industrial subsidies, and infrastructure investment, it will encourage companies to relocate production lines back to the U.S. and invest in cutting-edge technologies such as artificial intelligence, semiconductors, and new energy. A prime example is Apple's announcement of a $600 billion investment in a U.S. factory to circumvent tariff barriers. This is the very embodiment of productive investment. These investments not only directly create GDP and jobs, but also drive the development of entire industrial chains, enhancing the U.S.'s long-term economic competitiveness. The grand vision is that if the AI revolution, reshoring of manufacturing, and infrastructure upgrades can collectively unleash a new productivity boom, then at some point in the future, the U.S. economic growth rate could catch up with or even exceed the rate of debt expansion. By then, even if the total national debt could reach $40 trillion or even $50 trillion, as long as the GDP pie grows sufficiently, the dreadful debt-to-GDP ratio could be reduced to a relatively safe and manageable level. This is the solution the U.S. has laid out, hoping the world will believe in it. It's an ambitious plan that bets on America's unparalleled innovation and economic resilience. However, this plan has a significant, perhaps even fatal flaw: time. Improving productivity, building factories, and completing technological revolutions all take a long time, perhaps 5, 10, or even longer. Meanwhile, the U.S. debt problem is already pressing, with interest payments already exceeding defense spending and becoming the fastest-growing component of the federal budget. This will render this ambitious plan a mere castle in the air. So, in this race against time, does the U.S. have any hidden cards up its sleeve? While waiting for the long years of productive debt to bear fruit, how will it deal with the mountain of outstanding debt? This is the unspoken conspiracy we will uncover in the next episode.